Hi everyone, we're just going to do a quick, short, maybe 15-20 minute video on talking about sub 1 million sort of deals in the CF and sort of tax space. So we've got a few topics, a few areas that we want to discuss. So as an introduction, for anyone who doesn't know, I'm the Corporate Finance Director at Gravitate.
My name is Luke and I'm the Tax Director at Gravitate.
So we're going to try and tackle both sides really in that sort of sub 1 million space. Again, it's just our thoughts. Be interested to hear anyone else's thoughts in this area as well. But I suppose really to kick off then, I think the important thing is to understand, I think it's a good benchmark to start off with what's EBITDA, because that's an often term used in the deal space, if you like. So for anyone that doesn't know, it's a sort of valuation metric that is used to assess sort of business performance. There are others, but that seems to be the most typical one, particularly for established businesses. And really, it's looking at the true sort of sustainable profits of the business, ignoring the impacts of cash. So there's pros and cons of that. I think it's important to look not only at EBITDA, but cash flow from operations as well when making an assessment of an opportunity. But that's what EBITDA is. So it's profit before interest, tax and amortisation, i.e. stripping out any sort of accounting adjustments that go into making up the P&L. Mm-hmm. Why that matters then? So it matters really for just thinking about external stakeholders and for business owners to understand, because it strips out the non-cash items, it shows the underlying sort of earning power of a business, which is obviously important from a buyer's point of view if you're looking to sell your business, because really they're going to look at it from an investment point of view. What's the profitability of this business? If we're paying X, what's that going to generate and why over the longer term? Again, from a valuation point of view, it's often used, again, for established businesses, tends to be a metric that's often used. For banks and lenders as well, it's a measure for debt servicing. So if you've got any sort of finance or lending in the business, they'll use EBITDA as a measurement, and it'll be part of the covenant testing that they perform along with CAFADs as well usually. So important because it's a metric that lenders look at as well. And again, going back to that point, it's a sort of neutral benchmark because it ignores the impacts of tax and some accounting policies. So I don't know if there's anything else you want to add to that.
No, just more of the same really, and it's a very cross-sectional sort of terminology that's used in all sectors, because it's probably a fairly standard profit terminology in the sector, isn't it, that we would use. Hence why then banks can ask it whether it's a construction business or a consultancy business or anything, and it's got very similar sort of terminology.
Yeah, okay, cool. So next sort of topic area really is about sort of valuations and multiples in the space. So sort of why do typically sub 1 million EBITDA businesses get low valuation multiples? Well, really, from my point of view in the space, it boils down to risk often. Smaller businesses in that space, there's normally a higher dependency on the founders. And if you don't get your succession planning right, a buyer's always going to come in and ask, well, is the goodwill with you as the business owner, or is it with the business? And that's really important for an investor or a buyer to understand, because if it's with you, well, as soon as you leave the business, what's going to be the impact on that profitability, on that EBITDA when you leave? So for smaller businesses, there's more dependency there, so that's often what, it just increases the overall risks. I think for smaller businesses as well, generally speaking, again, not for every business, but can be sort of generalised, if you like, there's often a higher concentration of customers just because of the size. So again, that dependency on maybe one or two or three key customers sometimes for smaller businesses will drive the multiples down because of the risk. Again, what happens if that key customer leaves? What happened if that key customer's got the relationship with the founding owner that's going to leave? So all these things increase risk, and that's again, it's all generalised, but that's why sub 1 million deals often lower multiples. Again, a few other sort of, I think they're the main 2 points, but like limited management reporting as well. you know, often smaller businesses don't keep on top of their finances, so investors will look at the numbers first, and if you've not got that detail, then again it enhances the risk. Why are things moving up and down? Why is your profit and loss jumpy? Why have you not got a flat margin? Again, it just doesn't feed an investor with confidence that they can trust the figures that they're looking at in front of them.
I think confidence is the key thing, isn't it? That when the buyer comes in, if you've got all your MI to hand, you know your margins, you know why things have changed.
Yeah.
As a buyer, that's quite reassuring.
Yeah.
And in a large business, that would be commonplace. But in the deals of this size, it's, I would say, quite rare.
Yeah.
Just because of the profitability levels can't sustain a big enough board and structure to do that.
Yeah.
Which I suppose is what we can then help with.
Exactly, exactly. And I think, you know, you've got to think of strategic buyers as well. They might look at deals, and if you're in that sub 1 million space, well, you know, to get the same return, they're better off buying one bigger business than 4 smaller ones, because it just becomes a cost exercise. And those 4 smaller transactions that make up £1 million deal, well, that's 4 deal fees, transaction fees, you know, all of a sudden from an investment point of view it becomes a bit more of a costly exercise as well as looking at those deals, and there's more risk. So generally speaking, you know, there are fewer strategic buyers for those smaller businesses, and it just becomes more harder to find those buyers in that space, and gives those buyers more leverage because they know that position's the position
which helps them drive the margins and the multiples down further.
Yeah, exactly. So I think they're the main reasons why valuation multiples are sort of lower in that space and why it's more difficult. I think that covers that point really. So we touched on it already, sort of owner dependency and key risks. So, you know, sort of owner managed businesses are common in the sub 1 million space, and you know, I suppose the question for us, or the question that we sort of prompted ourselves, how do we see the risk of the key person dependency, and what are the financial and tax implications when structuring a sort of deal around this? So I don't know if you've got any sort of tax specific ones you want to kick off with.
I mean, I suppose in terms of structuring, I suppose the biggest one to think of, either what is the structure at present or what does it want to be. So it may well be that the director shareholder may own all the shares personally, or he may own it through a holding company. It's, do you know what I mean? It's completely separate. It may be that there is a preference to do it through a holding company, but that may not be set up. So that's where sort of the long-term planning works, that if you're looking to sell in 2, 3, 4, 5 years, you want to get your CF advice in and make sure that your tax work coincides with the CF work. I would say that's probably the main sort of tax implication really, because on the sort of flip side, and I think we'll probably come on to it on the slides later, is at this sort of level, on the current budget at least, the lifetime limit for business asset disposal relief is 1 million. So in theory, a deal value of sub 1 million shouldn't cause the tax issues that you would have if it was, say, 10 million, for example. So there should be less there. I mean, there are sort of the structuring issues in terms of how the deal is structured and how quick you get your cash, and do you know what I mean, what risks you protect, you're exposed to there. But I would say they are the main ones. And going back to owner dependency, the big thing I suppose with the buyer is how much do they want the owner to be involved, because usually we'd expect to see them around for 2 years, say, as a bit of a sort of transition. Which generally works pretty well. Some buyers don't want them there at all, and some would like them there longer, and obviously that may not work for the buyer, because they may want to sell into the sunset.
Yeah, and I think like most SME business owners in that sub 1 million space, you know, I think that the thing that they need to get their head around is, because of those increased risks, yes, they might want to leave on day one. Yeah. But I think in that sort of space, a buyer might want you to stay a bit longer because of those risk aspects and making sure that goodwill isn't with you. Yeah. So as your business grows, you naturally should start to sort of step away from the business and get a team to manage that, and that goes hand in hand. So I think in that sub 1 million space, it's just, I suppose really it's going into any sort of transaction knowing what the likely outcome is going to be and what the expectations are. I think if you go in there the danger is a lot of people talk to like sort of mates in the pubs and they've stepped away straight away, but you've got to understand the deal dynamics of that particular deal, and it might not be true and it might not be relevant to the business that you're sort of trying to sell. So yeah, tax advice comes into that, structuring, getting the right structure in place. I think the more proactive you are in that sense, the more a buyer's got confidence that you're taking advice. Because I think the worst thing for any advisors on a buy side, and we're on the sell side, for example, is when the other side aren't seeking advice, because it just becomes tedious. And again, it puts people off investing. So I think all these good things go hand in hand. It increases the chances of getting the transaction away as well, I think, if you're taking this sort of advice. Okay, so transaction cost versus deal size. So fees and due diligence can feel disproportionately high on smaller deals, which makes sense. So from our perspective, how do you explain the value of these costs to business owners? So I think for me, really, you can touch on tax DD and FDD, but it's right, there's no getting around it. I think, again, it's that understanding piece of there's the same level of work that goes into a sub 1 million deal off that there is a higher deal, so anything above that. So from a DD point of view, if again thinking of any DD, so if it's vendor due diligence on the sell side or buyer due diligence and you're acting sort of for buyers, I think it's just understanding that for a robust report and a robust due diligence exercise, it's better to spend the time and money in the long term. Because again, it's all about building that confidence in the numbers, in the answers that you're going to provide, either if you, on the sell side if you're doing vendor DD, or on the buy side if you're looking at sort of acquisitions, understanding that the more details actually the better, because it's going to reduce the overall risk perception on that deal. So I think it just smooths negotiations. And it prevents sort of costly post-sale trigger events. So, for example, if the DD wasn't done properly and there's errors post-transaction, then all of a sudden you're into litigation and the cost can get astronomical.
Extreme.
So the whole point and the purpose of DD is to make sure that doesn't happen. So it's worthwhile investing the time there, because it could cost you tenfold after in sort of legal costs and any
cash flow issues.
Absolutely.
We spoke about that one the other day, didn't we, where DD had not been undertaken on a deal and there was massive cash flow issues because the sale completed at sort of traditionally quiet months, and the purchaser had not got the funding in place because they were looking at the figures from the sort of peak months. So obviously that's quite a minor one, but obviously tax due diligence, as with CF work, will get into the sort of finer details. You wouldn't buy an old house without having a survey. So if you were buying a company, you take on the risks of whatever that company's done before. Fair enough, you've got your warranties and your indemnities, assuming you can recover them later on, but you really want to understand what's been done from a VAT perspective, what's been done from a corporation tax perspective, pay as you earn, everything. Because there may be things that are missing, there may be skeletons in the closet, and you want to understand them as part of DD, so that when you're going into the deal, I mean, if anything, you can use it as a leveraging exercise, because it may be that you're prepared to pay a much higher multiple, and these kind of can work in your favour to suppress the deal. I suppose if we were acting for a seller, then obviously we can kind of do the due diligence internally to kind of weed out what the buyers would be looking at as well. So it kind of works both ways. It just depends on how long a run up you've got to the sale. If you know you're planning to sell in 5 years and you can get these ready, then when you're looking at the due diligence, you may look at a 3-year window. That 3 years could be a really clean window.
I think we touched on that. It's like the importance of DD in a bit, and being prepared and telling that growth story on the journey. So all sort of valid stuff really. So I suppose the next slide we're talking about structuring and sort of tax considerations really. So I think the key thing for you, when it comes to sub 1 million deals, in terms of structuring, deal structure, generally speaking, if you're acting for the sell side, you want as much cash on day one to just de-risk. And if you're acting on the buy side, you want
all the way around,
because of the risk perception. I would generally say on smaller deals, it's not uncommon. Depending on the buyer is, they might take a view and keep the valuation fairly low, but are happy to pay
more upfront.
Tends to be what see in that smaller deal space. So you're not getting as much in terms of valuation. On the flip side, you could bridge that gap by including things like earnouts to bridge that valuation. I think the important thing is having an understanding what your actual business is worth before you go into a sale process. Because if you don't do that, and you go in with super high you're just going to
or super low. You might agree a deal and actually you were way off. And you had far better. You would have been far better. Getting advice and kind of pushing back.
But I think the key thing for me, what I see, and especially in this space, is the earn-out mechanism. And obviously, there's tax implications of the difference between deferred consideration, i.e. value
fixed.
a fixed amount where you know you're going to get it. There's normally a scheduled repayment plan on that deferred, and it's not linked to anything. It's not conditional on profits versus an earn-out where there is some conditional element. And obviously, there are tax implications of that as well, isn't it? So, it's important that before you even go into the process, understanding these likely structures, so that you're prepared when you get there.
Yeah, and that comes back to the slide before we were mentioning about management retaining a position for 2 years. If I was the buyer, I would be wanting them to do an earn-out to essentially say, well, work for that 2-year window. 1, to steady the ship, and 2, if you can push profits up further, that will give me far more sort of confidence that it's good, and if the seller is then getting an extra kicker at the end, then he's working as hard as well, isn't he? And then you're both winning. And I suppose we see that quite a lot in deals. Obviously, where the earn-out limits are set depends on how achievable they are. If they're set too high, obviously they're demotivating. But as Martin says, with the earn-out, you've got the fact that an earn-out may be worth nothing, or it could be worth $500,000, or it completely depends on what's part of the agreement. Obviously, the earn-out will be taxable, and probably the hardest thing to consider is what is the value of that earn-out at the date you make the sale. That obviously that we can advise on as part of maybe putting it into the contract. But in terms of sort of the wider sort of tax structuring sort of issues, whether you're selling sort of the company or whether you're selling the shares, I would normally be considering sort of the risk profile. So if we had a buyer, they would possibly want to buy their assets rather than the shares, just because then they've got no risk, they've got no history of whatever has happened before. That's easy for them. Seller will often want to sell the shares because that's far easier for them. Obviously, if you have it where the buyer is buying the shares, which obviously does happen, then obviously that's why they've got to go through the due diligence, because they're taking on that risk. And that is where obviously you've got then the mechanism for working capital and do you know what I mean, everything else which comes into the sort of the end figure. We've already mentioned obviously business asset disposal relief potentially not being too much of a problem. The caveat for that being is obviously if you've got an entrepreneur who sold businesses in the past, then obviously, and they've used the lifetime limit, then selling a business this time around for $1 million, they're not going to get the lower tax rates that they've had in the past. And I've already mentioned about whether the disposal is from a holding company or personally. Obviously, if the shares are disposed of personally, that director or shareholder has made a disposal. Whereas if it's a holding company that owns the shares, then the holding company's made the disposal, not the director. So it's two sort of different mechanisms, and what you do with the cash on the sort of the back end of that deal.
And you know the pre-sale stuff as well. So if there's surplus cash in the business, it might be tax advantageous to maximise your pension allowance. There's all sorts of things that you should be considering before you do the transaction. But I think the key is just preparation. Just make sure you're really well prepared, particularly on the sales side, because you know if I'm on the buy side and I can see a well prepared sort of plan and a mandate, and maybe there's a data room, maybe there's all sorts of things, I'm just getting confidence straight away that they've thought about it, and they'll be thinking about all these things that I want to see as a buyer.
And it's there in the data room ready for them to go.
Exactly.
And if they only have to ask a handful of questions, it's far better than a 5-page questionnaire.
Exactly. So I suppose that leads on to the last sort of point really around sort of growth story and exit planning. Really, to maximise the value, you know, it's important to tell a sort of clear growth story and focus on that. So, you know, and what do we need to do? What's involved in that from a sort of financial and tax planning point of view? Well, we've touched on a lot of the points already, but I think from the sell side, again, going back to vendor due diligence, so sellers preparing for sale, making sure you've gone through a due diligence process. So, do a trial run. We often do this with clients where
Yep.
they're looking to sell. Well, here's a due diligence profile that a buyer might put in front of you.
Yep.
Because why that's beneficial is it highlights areas that maybe you're weak in.
Yeah. That you didn't know before the process.
So that can cover things like contract strength. It could be key management incentives, tying key management in. Again, it depends on your business. So you've got to work. There's a bit of work at the beginning to set the right sort of foundation of what those key points are, but then working through that over a period of time is you're going to benefit much more in the long term. You're going to have a bigger pool of buyers that are going to be interested, and
hopefully a higher multiple potentially as
well. Higher multiple, deal's going to get done quicker, so you're reducing execution risk. So it's like anything, the more prepared you are, the more chance you're going to get higher value, and it's actually going to get away. Because deals will fall over if you don't have this information.
We see it happen, don't we?
Absolutely. So I think, that includes things like getting on top of your monthly data. A buyer's going to want to do some financial diligence, even if it's in the sub 1 million space. They still want to look at the financials. So making sure you understand your numbers, why things have gone up and down. Okay, just even if it's an explanation, that's enough a lot of the time. Okay, there was some seasonal variant, or somebody left during that time, or our key salesperson left and we replaced at this point. Really pinpointing why things are moving up and down. Again, it tells the story and it shows a buyer that you're on top of your business and you understand what's gone on, rather than just looking back at the end of the year and thinking, oh, how well did I do? You already know. You already know that position. So, I think the more prepared you are, the better, really, from a for sort of a main financial due diligence point of view, really.
Yeah, I agree. It's definitely worth investing the time into something like that, because generally speaking, you only exit a business once. There may be some entrepreneurs that do it a few times, but generally if you're doing it once, you want to do it right.
Yeah, things like from a tax DD and VAT DD, I'm just thinking about making sure those VAT returns are in on time, making sure your tax returns are in on time, because what we often find as well is from a selling point of view, if there's any sort of red flags, or things are missed, or things are late, or there's fines, penalties, it just gives a buyer room to negotiate and say, actually, this increases our risk.
We're going to chop this off.
To the price, or we need this extra warranty or indemnity. So being prepared, making sure you're doing things when you should be doing them, on time, well in advance of the sale. And it just gives a buyer confidence, but also less chance that they're going to come in and renegotiate on items. I think they're the main points, really.
You're spot on. I think the one that I see all the time is if you've got a property and it's been opted to tax and it's been done 15 years ago, the buyer will ask for proof of it and you can't find it. You ask for it from HMRC and it might take 6 months. Well, that's not going to, do you know what I mean? That's just going to push the deal back, or it could collapse. And it's like, you just rather get that done before, have it ready. And then it's just in the pack, and it will just be far more streamlined.
And if it's a buyer where they need it as well, you could end up spending thousands on legals just to get to the bottom of it. Whereas you could be paying hundreds to get it sorted out at the beginning, rather than thousands later on. So again, it's all about being prepared. It's to get you what you want, but also save costs in the long term as well. So okay, so they're the main bits we wanted to talk about. Hopefully that's been helpful. Just short video, as we're trying to do a few more of these on certain topics. So, if you've got any questions or you want to get in touch, feel free to do so.
Thank you all for watching.